watching Medfield TV, community shows.
Welcome to Simply Legal. I'm your host, Geraldine Warren, longtime Medfield resident and practicing attorney here in Medfield. As the viewers are aware, each month I present a topic that I know you find both interesting and useful. Today will not be an exception. I'm very lucky to have with me today Steve Pepe, who has an extensive resume, so I'm going to let him tell the viewers a little bit about himself.
Hi, Geraldine. Thank you for having me. So, yes, my name's Steve Pepe, and I'm a loan officer for a company that specializes in lending reverse mortgages to older homeowners. I live in Milford with my wife, and our office is also in Milford, and I cover the whole state, helping older homeowners who are looking to tap into some of their home equity. I'm an attorney also by background, went to Suffolk University Law School, and I'm also a former reverse mortgage counselor prior to getting into the lending industry in the world of reverse mortgages.
Well, as the viewers will see then, you're very experienced in the area of reverse mortgages.
Yes.
Can we just start with maybe explaining what is a reverse mortgage?
Sure. So when we use the term reverse mortgage, we're really talking about this one program in particular that's insured by the federal government, the FHA, which is the Federal Housing Administration. It's called the HECM, or the Home Equity Conversion Mortgage.
So not to interrupt,
yes.
So that's when you see the HECM.
Yes,
so, okay.
When you see HECM or reverse mortgage, those are both talking about the same thing. It's a federally insured mortgage program that enables homeowners who are over 62 to get at some of their home equity so they can turn it into cash and spend it on whatever expenses they have in life, whether it's home care, home improvement, just paying the bills, or making their retirement portfolio last longer, or whatever the case may be. It's a way for them to borrow against some of that home equity without having to worry about having another monthly payment during their retirement years. Because reverse mortgages, unlike virtually any other kind of mortgage, does not have to be repaid until our borrower no longer lives in that house. So if they sell the home or pass away or move out for more than a year, that's when a reverse mortgage is paid. So older homeowners are finding all new ways of utilizing it to live in their home comfortably, not have a new mortgage payment for as long as they live in the home, have access to tax-free cash, have their other retirement assets last longer, and be more self-sufficient, really.
What are the requirements to getting a reverse mortgage?
So at least one homeowner has to be 62 years old or older. If we're talking about a married couple, at least one of those spouses has to be 62 or older. Has to be a primary residence, so you can't use it on a second home or an investment property. It can be used on a house, a single family house, a condominium, a 2 to 4 family owner occupied home. If a homeowner has come to an elder law attorney like you who has set up an estate plan, putting their home into a trust or a life estate transfer, that's all compatible with the reverse mortgage. And a lot of people think you can't have any mortgage currently on your home to get a reverse mortgage, and that's simply not the case.
So you could have a first or second mortgage and still get a reverse mortgage?
Yes, in fact, that's one of the most common reasons why my phone rings, is someone has a mortgage or a home equity line of credit, and that monthly payment is becoming a burden. And so they're looking to eliminate that mortgage debt. And so as long as we can lend that person enough money to pay off that existing mortgage that's there, then absolutely they can go ahead and get a reverse mortgage. Something that's relatively new for eligibility in the last couple of years is we now look a little closer at a homeowner's income and credit than we used to. And we want to make sure that any one of our borrowers has sufficient income and credit to continue with their real estate tax payment, their homeowner's insurance payment, and their condo fees if they live in a condominium. It never used to be the case that we had to look into that, but now we do a little more. Certainly not to the extent of a regular mortgage with a monthly payment, but we do have to look a little more closely at that.
So you think this is an important financial option then for people that are over 62?
Absolutely, and historically and admittedly for the last 20 plus years that this loan's been around, because it was created during the Reagan administration, and the first reverse mortgage was written in 1989, and about 1 million of these have been written since then. These were historically seen by homeowners and their professional advisors as a loan of last resort. Like, people thought this was the only option left if you've exhausted all of your other money and you have nothing left. That is changing for a number of reasons, where now this is being seen as a product of choice. Financial planners, attorneys, accountants are starting to pay closer attention to this loan as a way for even more affluent homeowners who might live in Medfield or Dover or other towns that might be viewing this and already have several $100,000 or $1 million or a couple $1 million saved, but they might be 65 and are worried, will that money last for my whole life? It's a way that advisors are now looking at extending the longevity of those other assets so that a person never will run out of their money by setting up one of these reverse mortgages.
Does it come in handy too if someone has a catastrophic illness?
Absolutely, and that is now becoming my most common call that I'm getting, is people who are looking to fund private pay in-home care. Because Medicare only covers so much, the VA might only cover so much, Mass Health might only cover so much, and people usually have to dip into their own pockets to pay for the care to come to them, or to make changes to their home or changes to their vehicle to be able to afford to stay in their home if they have a catastrophic illness. Long-term care can be very expensive, and those folks may or may not have a long-term care insurance policy in place.
And even if they do, it doesn't always cover everything. You usually get it so much per day.
Correct.
Like $125 a day or something, and
Right.
you and I both know home care is very expensive.
Very expensive. So I'm getting calls from older homeowners or their younger family members who are saying, we're paying $5,000, $7,000, $10,000 a month to pay to keep mom or dad at home. So a HECM is another way to access the home equity to be able to pay for that in-home care. Because again, there's very few restrictions on how this money can be used. In-home care is absolutely one of the ways this money can be used. So a homeowner can now set up one of these HECMs very inexpensively, set up a line of credit, utilize that line of credit as the care bills come in, and unlike a regular home equity line of credit—
I was going to ask you, how is it different from home equity?
Sure.
Yeah.
So one important way is, of course, no monthly payment that we already mentioned. Second important distinction is that a HECM line of credit can never be called or shrunken in size by a lender, unlike a home equity line of credit, where the lender can absolutely do that. And during the real estate crisis that did happen during '98 and around that. Also, unlike a regular HELOC or home equity line of credit, a HECM line of credit grows larger over time. So this is one of the features that Congress built into the program when they created the program in 1989. So regardless of what happens to the value of your house, if you set up a HECM line of credit and don't touch it, it will be larger in a year, and in 2 years, and in 3 years than it was on the day the loan closed. It's growing tax-free, and it's growing at a much larger rate of growth than your money in a CD or a money market account might be growing. right now, these HECM lines of credit today, when the day this is filmed, they're growing anywhere from 4% to 6.5%, 7% per year. So someone who is 62 and is in a $700,000 home can set up a HECM line of credit that has maybe a few $100,000 available in that line. And if they don't touch that HECM line of credit in 20 years, that line of credit will be over $1 million, whether their home went up in value or went down in value. Now think of the power of having $1 million bucket of available funds to then pay for long-term in-home care if there's a long-term care event. That's a lot of money at your disposal, and that will pay for several years worth of care. And that $300,000 HECM line of credit that grows possibly into $1 million line of credit can be set up for just a few $100s in closing costs today. So that, Geraldine, is another reason why these are being seen as a viable choice, a voluntary choice, and not a product of last resort, because these used to be several years ago.
I thought of it as
Very expensive option in years past, where you could have heard of $10,000, $12,000, $15,000, $20,000 in closing costs. Today, these can be set up in Massachusetts for as little as $175 in closing costs.
Well, you know, that brings me to the next question I had for you was, what are the changes that have recently happened? I know I've been reading some things that come up. You actually have written some newsletter information that I've received that talk about the changes. Do you mind just reviewing those for the viewers?
Sure. So I just started talking about one of them, that the costs have come down as an industry. Without getting too technical, there's a couple reasons why. One is HUD and FHA, who are the insurer of the loan. They changed the fee structure on how they charge their insurance premiums. So that's one way that costs came down. The other way is that lenders like my company and other companies out there are bringing down some of their costs. So the combination of those two things have brought the costs down. Second change that's happened recently, I touched on it a few minutes ago. We now look a little closer at taxes, at income and credit. And that's a good thing, because we want to make sure we're not setting someone up for failure, that we're getting them into this loan in a home they just can't afford. So it makes it a more stable and sustainable program for the homeowner and for the industry in general. Third change is there have been some improvements for spouses who might not be named on the title to the home and therefore might not be borrowers under the reverse mortgage. So spouses like that who, historically it's been cases where one spouse is over 62 and named on the deed, and one spouse was under 62 and not named on the deed for whatever reason. And they got a reverse mortgage. Well, the reverse mortgage could only be in the 62-year-old spouse's name. And let's say that those spouses set up a reverse mortgage, they live in the home a while, and then that older spouse, who's the HECM borrower, dies first. That younger spouse has exposure. They then would be faced with a very difficult decision where they would have to pay that loan back within a year, and that might mean having to sell the home and move out of the home they love. So no one liked that scenario. No one wanted that spouse to be in that scenario. So changes were made so that now on any new loans, if that same couple finds a lender and still sets up the loan in the older spouse's name, and then that older spouse dies first, the younger spouse can remain in the house, doesn't have to pay the loan back, and can remain there for the rest of their life.
That's a big change.
Significant improvement. And everyone is happy about that. HUD's happy about it. The lending community's happy.
Fairness.
Consumer advocates are happy, and the homeowners are happy about it. So you have to be very careful and set up the loan just so. So you've got to talk to your attorney about it, talk to the lender about it, make sure the steps are taken so that that spouse is protected just in case something like that occurs.
Now, I know that you mentioned earlier on about trusts and you can still get a reverse mortgage. So if you have an irrevocable trust, are you able to get a reverse mortgage?
On a case-by-case basis, lenders like the lender I work for will consider them, and I have written transactions where the home is in an irrevocable trust. I'm not going to blanket say across the board it can work every time, but again, you have to talk to the attorney and talk to the lender and see, is this lender one who will work with me and will do it, and other companies will do it on a case-by-case basis. We want to see the language of the trust.
I was going to ask you, is this a particular language that they're looking at?
So we are looking at the powers of the trustee, authority to mortgage, and we have to look and see powers to disperse income only or principal, and usually it's income only. So a lot of times the way this will be structured, and the couple times that I've done one of these transactions, has been as follows. We'll set up the reverse mortgage. Any disbursements from the reverse mortgage have to be dispersed to a bank account owned by the trust. That's in the name of the trustee of the trust.
And that would require getting a separate tax ID number.
Correct. And then the lender will disperse funds to that trust bank account, and then it's up to the trustee to then handle those proceeds according to whatever their powers may be within the trust document. So we're not giving advice to the trustee on what they can or cannot do. That's for their attorney and them to decide. But we will fashion a transaction that does that.
Okay, that's good to know. So I think we kind of touched on what the advantages are, but I just thought, do you want to just review again like some of the advantages of the reverse mortgage?
Sure. So again, advantages of reverse mortgage: a way for any homeowner who's over 62 years old to get access to a portion of their home equity in the form of tax-free cash to be able to utilize to pay off a mortgage, fund in-home care, fund whatever daily expenses they may have. I recently had someone who used it to fund their grandkids' college tuition, utilize it in any kind of gifting strategy or any kind of strategy that they might be, with the advice of their financial planner or attorney, of course, and not have to worry about making any kind of monthly payment for as long as they live in their home as their primary residence. It's a kind of mortgage that's insured by FHA, the Federal Housing Administration, so it can't be called, it can't be reduced in size. That reverse mortgage can grow bigger over time. They can set up the reverse mortgage to have a line of credit, like a regular home equity line of credit, a stream of income called a term payment or a tenure payment. They can take a portion as a lump sum if they want to clear up credit card debt or just have a little bit more money in the bank. And it's a way for them to enjoy their primary residence and not worry about where am I going to get some money to pay the bills. And if they're more affluent, it's a way to have their other portfolio, their other assets perform better if they're not having to reach into those other assets and deplete them. So it's a great way for more affluent people to have access to more cash and let their retirement portfolio grow. Yeah.
What if they, I know you said they look at income more than they did in the past. What if they had significant equity, let's say, in the home, but they're only on Social Security, no 401k, no IRA. Now, would that person be, would that be available to that kind of person?
It would still be available to that kind of person. So rather than a flat-out denial, here's how the industry would treat a homeowner like that. So what we do is we take a look at, all right, what is this person's income? It's just Social Security. Let's say it's $1,500 a month or $1,200 a month. Then we look at, what is your real estate tax bill? What's your homeowner's insurance bill? Do you have any other regular recurring bills, car payments, credit card bills, alimony payments, things like that? And we subtract those from their monthly income. and we see how much they have left in what we call residual income. And if that residual income is over the HUD threshold, that person is qualified. That's as far as we look. We don't have to do anything else. And it's a low threshold. It's a little over $400 a month for a single person, a little over $900 a month for a household of 2. And then there's thresholds for a household of 3, household of 4.
Oh, okay.
Okay? If they're under the threshold, they won't get denied necessarily. I've yet to see a denial because someone's under that threshold. What the lender will do is they'll say, we're a little bit concerned about your ability to keep paying your taxes and insurance in a timely manner. So, Mrs. Homeowner, we're going to take a portion of your loan,
Like an escrow account?
like an escrow. We're going to put a fence around it, and it's called a life expectancy set-aside account. We calculate how much in taxes and insurance we expect you're going to be paying for the rest of your life expectancy.
Do you base that on Social Security table?
Yes, on the Social Security table. We set that aside out of the money we're going to lend them, and we say, every 6 months, we're going to take a little of this money and we're going to disperse it to you. And we hope you're going to turn around and take that and pay your taxes and insurance. It's a way of an insurance policy of sorts of making sure
Someone doesn't get in trouble.
yeah,
right?
someone doesn't get in trouble. If someone has income problems, I'm sorry, credit problems, all right? Late payments on credit cards, a recent bankruptcy. Again, they're not necessarily going to be denied, but we want to find out, why did you get into credit trouble? Explain it in writing. Maybe there was an illness, maybe there was a death of a spouse, maybe there was a divorce or something like that. Maybe a child got sick and you had to help them out and you got behind on your own bills. Again, we're not necessarily going to deny you, but we want to know, why did it happen? Is it likely to keep happening? And if they have credit issues, we're not necessarily going to deny them, but we're going to, again, set up that escrow account. It's the same life expectancy set aside. But in that case, we're going to say, Mrs. Homeowner, we're paying your real estate taxes. We're paying your homeowner's insurance. We're paying your flood insurance for the rest of your actuarial life.
Now, is there a fee for them to do
No
that?
fee for us to do that.
Wow.
Yeah. So a few less bills for you to worry about. And that way the town's happy. They know they're going to get their taxes. We're happy. We know there'll be no technical default on the note for lack of taxes, lack of homeowner's insurance. FHA's happy, and the homeowner and their family should be happy. Homeowner can volunteer to have us do that. And I've had 2 instances where a homeowner did just that. They said, look, these bills are getting overwhelming for me. And in another case, the family said, Mom's 90. We're worried she's going to miss a payment. Even though her credit's perfect, her income's great. Can you please set up one of these escrow accounts, these set-aside accounts? And we've said, absolutely. Now we're in charge of paying taxes and insurance.
That's a
and
nice
everyone's
service.
a lot happier. Yeah.
Because I find sometimes my clients will miss long-term care insurance payments, premium payments, because of their age and maybe the competency is becoming an issue, and then they lose their insurance. I mean, so
Right.
that's a really nice service to have.
Right.
And there's no fee for that.
No
And-
fee for that.
Okay.
And this is one way where reverse mortgages or HECMs and regular mortgages are no different. I challenge anyone to find a mortgage in Massachusetts or in the United States that doesn't say, you, Mr. and Mrs. Homeowner, must pay your real estate taxes, must pay your homeowner's insurance, must keep your home in good repair. Every mortgage everywhere says that. And in that way, a HECM is no different. So these are some safeguards to help our borrowers be a little bit better at keeping up with those things.
Now, do they have to talk to a counselor before they
Yes,
talk to you? Because I know
absolutely. This is another way. The only other kind of mortgage that has this kind of step are first-time home buyer loans. You'll see will have this, where, and this is how I got into the reverse mortgage industry 12 years ago. Every single person who wants to apply for a reverse mortgage has to do a required counseling session with an approved reverse mortgage counseling agency. So these counseling agencies are nonprofit agencies all around the Commonwealth. There's about a dozen of them. It's a face-to-face, one-on-one session. It's a one-time session. It takes a couple hours to do.
Can I just, do the counselor, do they go to the person's house if there's an issue?
A few will go to the person's house if there's mobility issues, but they don't all go there.
Okay.
They will charge more for the travel, so you've got to be mindful of that. But the counselors don't work for any lender, and their job is to go through what the program's all about, what all the costs are, what all the positives are, what the potential negatives are, what alternatives might be out there. They're even a great clearinghouse to tell Mr. and Mrs. Homeowner, do you know about the fuel assistance program? Did you know your town has a real estate tax abatement or deferral program for senior citizens? Things like that, a great conduit to other programs that a homeowner could potentially access. That has to occur before a homeowner can apply for a HECM reverse mortgage. And again, everybody wants that to happen. Lenders want it to happen, HUD wants it to happen, the Commonwealth wants it to happen, so that our borrowers can be the most well-informed customers possible. Homeowners can have their family sit in on it. They often do have a child or a grandchild sit in on it. If there's a question of mental capacity of the homeowner, a person's attorney in fact under a durable power of attorney or conservator can do not only the counseling session but the whole entire transaction for the homeowner. So it's a great step. It brings us better informed homeowners. It assures the homeowner that someone that wears my hat is not hiding anything from the homeowner and not pressuring the homeowner. And it's a great requirement. And it's got to be done, again, face-to-face in Massachusetts. It can be done by phone in every other state. And the fee for the counseling is usually around $175 if the homeowner is going to the counselor's office. If the counselor goes to the homeowner, you can add a couple $100 on top of that.
Because of the extra time and
the extra time and the travel, right.
Okay. Are they, and they're certified by the state?
Certified by the Commonwealth of Massachusetts, both the Executive Office of Elder Affairs and the Division of Banks, and also by HUD, the Department of Housing and Urban Development. And your viewers can go on the state website, www.mass.gov, and do a search, reverse mortgage counselors, and they can get the complete list of reverse mortgage counseling agencies. And every lender that they might be talking to has to give the homeowner a list of counseling agencies, and the lender cannot steer the homeowner to or away from any counseling agency.
Is there a time requirement, like they have to see them so much time before they apply, or
They
like,
have
what
to
if they
see
wait
them,
a year
yep.
before they?
At the conclusion of the counseling appointment, they're given a certificate. The certificate's valid for 180 days. So they have to see the counselor within 6 months of applying. Yes. Mm-hmm.
That's important to know.
So I counseled almost 1,400 households nationwide as a reverse mortgage counselor when I was counseling.
So you've been on both sides
On
of
both sides. So I was the staff attorney at one of these counseling agencies up in Stoneham. And I was wearing my staff attorney hat and my reverse mortgage counselor hat. And I love the business so much that I made the career change about 12 years ago. And
you're a member of Mass NALA as well.
Yes, member of Mass NALA. I've been a member of Mass NALA for about 12 years. I've been in the lending industry for about 12 years. I still have the law license. I just keep it in my back pocket. So I find it helps me to be more effective in talking to practitioners like you about life estates and estate plans and trusts and things like that. Helps me be better at my job.
And why I wanted you here today too is because I think it's important for the viewers to understand reverse mortgages. You see the commercials on TV, but you never really truly understand exactly what the reverse mortgage is.
Right. It's a complicated financial transaction. You can only squish so much into a 1 minute or 2 minute commercial with a celebrity or something else. Nothing on those commercials is incorrect, or nothing that I've seen on one of those commercials is incorrect, but it's certainly not complete. I mean, there's so much to learn about one of these. So I'd recommend anyone who's considering one of these to get counseled, talk to a lender, talk to an elder law attorney who has some exposure to these transactions, and find out all there is to know. There is some information online. AARP and the National Council on Aging and the Commonwealth of Massachusetts on mass.gov all have a lot of good information online teaching homeowners about reverse mortgages, but it's a learning curve. There's a lot to learn about these loans. Don't just rely on what you hear in the commercials.
Well, this has been great information, and I think that the viewers get a better understanding of a reverse mortgage, and you've given them some places to look up, you know, as far as mass.gov, because there's a lot of information online.
Sure.
And we're also going to have your information on the TV program as well, so if someone has a question, they can contact you directly.
Absolutely. They're more than happy to talk to anyone who might want to call me on the number that's appearing on the screen, and I'm more than happy to give them any of this information, including a counselor list.
That's great. And I guess we're going to just wind up the show for today. Is there anything you might want to add before we do?
Again, you may have heard all kinds of things out there about reverse mortgages, some of them true, some of them not true. I just encourage people, do your own research. Again, talk to an elder law attorney, do your own research online, talk to a lender, get all the facts before making a decision. And keep in mind, these aren't just a product of last resort anymore. They are meant for people of any socioeconomic level, even affluent people. And they're a great tool for homeowners over 62.
Really, thank you so much for being here today, Steve. I really appreciated you giving this information to our viewers.
Thank you for having me.
And to my viewers, remember, it's always simply legal.
The preceding was a production of Medfield TV, Community Shows.